But we start with what else? Another record day on Wall Street, as the snazzy animation says. The S&P 500 and Nasdaq closing at all-time highs. The Dow up, gold up, oil up, real estate up. Guy?
Yes, sir.
What's up?
Bonds unchanged. It's sort of a repeat of what we've been talking about now for quite some time. Last night, we obviously led with Apple. What's the deal? And we talked about the price action should have been much worse. I know Karen spoke of this. Tim did as well. We talked about some of the suppliers, Corvo. We talked about Skyworks, the fact that they weren't down nearly as much as they should have been. Then you look at those stocks today, up 2%, 1.5%. Apple up big. I mean, the flows continue to come in. Bad news is discounted. Market wants to go higher. You could say the Fed has our back. I don't know what's going on, but I'll tell you something. Gold continues to rally. Newmont Mining continues to rally. That is a concern, I think, if you want to continue to take the bull thesis in the S&P 500.
Right. So the concern should be, look at the U.S. dollar up 3.5% in essentially year to date. Look at the fact that you're getting this move higher in gold. You're getting some of these, call them defensive trades. At the same time today, semiconductors, that which, 2 weeks ago, we're questioning whether you were actually running into global cyclicality yet again. All-time highs, up 2.5% on the SMH ETF that tracks the semiconductors. So really what we're seeing right now is this barbell trade. You're seeing people reach for one side of their buying growth. The other side of it, they're buying some of these either value industrial kind of beaten up plays or utilities REITs. That's the trade that's working. It's both sides of the ledger. With rates here and the Fed not moving, that's the dynamic.
Yeah, I would just say this, that, when you think about 2019, the almost 30% gains in the S&P 500, we know a lot of that came from multiple expansions. So if you came into 2020 and you said, this is the year we get paid, we're going to get that high single digits earnings growth. I think what the coronavirus tells us, no matter what you think about it, when it's going to be over and when the quarantines are going to be done and when China's factory to the world is back online, you just lost Q1 2020. That's just a fact here. So the notion that you think that we're going to see this V reversal because whether it's accommodative policy all over the place or pent-up demand, I think it's pretty lazy commentary. I see that permeating a lot of investors and a lot of financial media, and I'm just going to tell you that, so if you're going to go for 2 years where you're just going to get multiple expansion, I think that becomes pretty dicey when you see rates where they are and all those things that you just mentioned. Why is gold up? Why is utilities gone parabolic? Why is Bitcoin up 40% on the year? There seems to be some disconnect here, and if you look at the S&P 500 equal weight, you say to yourself, oh, I get it. It's MAGA. Right. Microsoft's up to 18%, Google, Amazon, and the other one, whatever, Apple, all up mid-teens or something like that. And you say to yourself, that's where we are right now. So all this other stuff that makes sense to me is acting like risk off, but then those names are just risk on.
Yeah, I mean, to your point, the VIX, which normally, like a day like today, I would have thought would have come in a lot more. It's not. It's 1438, I think it closed. So I'd like to buy more protection because I'm always long, and I'm feeling like this is getting somewhat frothy. And I was hoping the VIX would come in, but it's not. So to your point, I think that there's signs of
Let's go through the numbers. I'm looking at my screens here. I'm just going to throw some numbers out.
Numbers out.
Here we go. Some numbers. We're going to throw out some numbers.
Here we are.
Go. All right.
Thursday.
The Nasdaq 100. 4 stocks, Tesla, AMD, Mercado Libre, and NVIDIA, have doubled in the last 12 months. Only 17 stocks are down in that time, and about 70 stocks are up more than 20% in a year. I understand the concept of multiple expansion. I get it. But can we have multiple expansion for everybody?
I don't know. I mean, I think to look at the last year, though, I think that coming in and looking where we were February of 2019, things were really depressed. So I think that multiples should have expanded from there because they were too low.
Because that December 18 collapse.
Collapse, exactly.
So a lot of that is just kind of climbing out of that hole.
Exactly. But still, those are, even when you get out of that hole, there's still
At what point, like a waistline and a belt that's too small, Guy?
Why do you look at me when you say that?
I'm tapping my own stomach here,
He was going to his own
At what point does the expansion get too much?
So for me, when I got to a 36 waist, I said, this is
the end of the expansion.
This expansion is over.
That's my dream.
You ran an Ironman.
Yeah.
And I got down to a 30. That's why I'm trying to stay as well. To answer your question, at a certain point, this passive investing is going to end miserably. And I think it's going to end, stocks take the stairs up and the elevator down. That's what's going to happen. We've seen bits and drabs of it. We can talk about WeWork. If that were a publicly traded company, when it went down 80% over the course of 3 months, we talk about it every day. To think that individual stocks can't do that, I think is foolish. But as long as the market believes the Fed has our collective back and this passive investing continues to be the rage, the market goes higher.
And this is the point with lower rates, because whether you're doing a DCF model or whether you're looking at a weighted average cost of capital for a company, the lower you push the rates, the higher the multiple goes. So as much as, and I like to point out that whether it's price to sales, whether it's EV/EBITDA, whether it's PE numbers, we are back at 2000 levels, but we're not doing it with the same rate environment that we had back then. And it's all, to me, about central banks and the Fed. If we had any other conversation, we wouldn't tolerate it.
One really quick point, though. When the 10-year Treasury breaks the 2012 and 16 low, which it will in 2020, that DCF thing may go out the window, because those were generational lows in yields, and why they're breaking and why they're heading to 1% may be the reason why you don't want to own stocks.
Discounted cash flow. The banner at the graphic said is a correction coming. Is a correction coming this year?
Sure.
Yeah,
sure. Of course there's going to be a correction this year. Okay. How are you defining correction? Again,
10% from the highs.
Why not? Why not? Especially when you consider that we've gone up about 16% on the S&P since October 3rd. Of course we should correct that, especially because this was a QE4 inspired rally for markets that weren't even expecting this. Yes, I think we get it.